Hey, what's going on? It's Jaron. Have you ever noticed that you won't be in a conversation about real estate very long before the term equity comes up? And if you don't know what equity is, it can be hard to kind of follow along. So I want to explore some of these terms, including equity, leverage, forced equity, debt, asset, liability, all of these terms that real estate investors use, but also you should be aware of so that you understand how to navigate the real estate world. Well, real estate investors are expert in these terms and exactly how to use them to their advantage. By the end of this video, I want you to have a general understanding of these terms and even an understanding of how real estate investors are using them to their advantage. Well, equity is really relatively simple. To understand it, we have to zoom out of the monthly cost of something and examine two different terms and how they interrelate. The first term is market value, or your asset value, and the other term is the debt or liability against it. If you know those two values, you're going to determine your equity. So now we can thank future me for editing in some of these graphics to help illustrate our points. Okay, let's use an example. Let's say I buy a home for $200,000, but instead of paying cash for it, I'm going to put $20,000 down payment, or 10%. So that $20,000 goes towards the purchase, but I also have a $180,000 loan from the bank. That's the liability or debt against it. Well, that $20,000 that you put into that property, it still has value. It's not like you just went to Paris for a month and spent $20,000 and that money's gone. $20,000 in your home is there in value. If you were to liquefy that asset, in other words, sell it, pay off the debt against it, now what's the cash you'd have left over? $20,000. So by the way, net worth is just a fancy term for all of your life's equity. So it's all of your assets against all of your liabilities or debt against it. So if you have all these assets spread out between stocks and real estate and everything, and then if you have debt against some of that real estate, or if you have some credit card debt, you're going to subtract all that from all of this positive, and what's left over is your net worth. So when you hear people say they're a millionaire, they often don't have $1 million in the bank. They have $1 million worth of equity overall after all of their assets minus their liabilities. Okay, back to real estate. So when people are looking for deals in real estate, what they're really looking for is more equity than what they put in for that down payment. So to look at our earlier example, if you bought that home for $200,000 and you put $20,000 down, well, you had $20,000 in equity. But let's say you turn around and sold that home a week later for $220,000. Well, if that home is instantly worth $220,000, you don't have $20,000 in equity, you have $40,000 in equity. So you see how that works? The same thing goes if you buy your property and during the transaction you get the property appraised and they come back and say it's worth $220,000. Well, you have what's called instant equity. So anecdote, dads love to point out two things when they're helping their children buy homes for the first time. First, they love to point out the electric panel and show you how to use it. The next thing they love to do is when your appraisal comes back and it's higher than what you paid for it, they love to proclaim instant equity. Dad jokes, sorry. So when you buy a home that's worth more than what you paid for it, you're walking into equity. And equity is great to walk into. Ah, sweet, sweet equity. Sweet, sweet equity. So investors are going to use the above example where they're going to buy a home for a little bit less than they know that it's worth. And that's called wholesaling. They're going to turn around and sell it days later or even the same day. They're going to find a new buyer before they even close on the purchase. And then wholesalers are going to make about $10,000 to $30,000 a deal. And if they do it on scale, they can have a pretty good living. You're not really putting any time or money into the property. You're just buying low and selling for a little bit less. These properties typically are distressed, so a wholesaler is going to sell to a flipper. So let's talk about flippers because they take it a step further. So by the way, most of the guru videos that you see that are like make $20,000 a month just by driving around and making phone calls and doing nothing, it's wholesaling. and you're not doing nothing. It's not passive income at all. It's hard work. And they spend a lot of money marketing trying to find those deals, by the way. All right, before we go to flipping, this might be a good time to point out that yes, I know there are transaction fees and lending fees and closing costs and other things that go into a purchase. I'm just using round numbers. Okay, so flippers are going to do the same thing as wholesalers, and they're going to buy something knowing that it's worth a little bit more. But instead, they're going to use my second favorite type of equity. It's called forced equity. So forced equity is when you create a bunch more equity by putting a little bit into it. So a flipper is going to buy for that 200. They're going to put $40,000 into it, knowing that in the end it's going to be worth $300,000. So they put $40,000 into it and made $60,000 extra equity, and that's forced equity. Flippers are going to sell the property in the end, and they're going to realize those gains, but if you held onto that property, all that paper equity would go towards your net worth at that point. Flippers doing this in scale can make between $30,000 and $100,000 plus per property that they flip. Now, to be in that $100,000 profit area, you're going to be in the $700,000 or $800,000 final market price or more. But I'm just saying that's what they do in scale, and that's what their business is. So speaking of flipping, what if you flip the equity over upside down? You have negative equity. Well, negative equity, if you haven't guessed it, is my least favorite type of equity. In fact, I despise negative equity so much that I'm not even going to use the superior asset class of real estate in my example. Instead, I'm going to go where negative equity is often found in cars. So now we're going to buy a car for $20,000, but we're only going to put $2,000 or 10% down on the car. We're going to get a loan for $18,000, okay? If you don't have perfect credit and you're only putting $2,000 down on a car, you might have a high interest rate. So you have a high interest rate, you're not paying down your balance very much. And guess what else Dad likes to point out? The moment you drive that thing off the lot, it drops in value. So that's how you get negative equity. That $20,000 car that you bought, if you go to sell it a year or two later, well, now it's only worth $16,000, but your loan is still worth $17,000. So that $18,000 loan, you've only paid about $1,000 down on it. The balance is still $17,000. So wait, I have to sell a car for $16,000 to pay off a $17,000 loan? Yeah, that's negative equity. And guess what? The car dealer would be happy to wrap that negative equity into your next purchase and add it on to the negative equity that you're going to have a year later on that next purchase. So the moral of the story is don't buy cars until you can buy cars with passive income, which comes from leverage. So next let's talk about leverage. So leverage is simple. It's really just a fancy term for debt. It's where you're only putting forth that $20,000 to buy a $200,000 property. And the reason it's called leverage is that you have the equitable interest in the whole property. So that $200,000 property raises in value by 5%. That 5% gain of equity is yours alone. It doesn't belong to the bank. You still owe the bank $180,000. That never changes. It only decreases by the payments you make on it. But that home could double in price in 3 years, and that's all your money, but you only put $20,000 on it. So let's compare how that works against stocks. So if $20,000 of stock rose 5% in a year, you'd have $21,000 of stock. But if you put $20,000 into a $200,000 property, the $200,000 property rises 5% in a year, and now it's worth $210,000. So you've just gained $10,000 of equity on something that you only put $20,000 down for. So that's a 50% return on your initial investment. Now, this is also a good time to prevent some roasting in the comments, because yes, I know that if you're buying an investment property, you're going to be putting 20 or 25% down on the property, but there's also ways to not do that too with seller financing and things like that. I'm just using some of these numbers as easy examples, okay? But roast me anyway. The second way that leverage works great for real estate investing is by the yield that your investment produces. So yield is like the cash that is coming to you outside of the equity in it. So if the property's worth $200,000, $220,000, and it gains in value, you gain in equity. But if you rent it out, that's called yield. Just like if a stock pays you a dividend. So a lot of stocks pay about a 2.5%, maybe 5% on the high end of a dividend. And these are just certain types of stocks, by the way, I didn't mean to say a lot of stocks pay 2.5% dividends. That's just not true. But high dividend stocks are up to 5% or so. And if you put $20,000 on a dividend stock to get 5%, they're going to give you 5%, $1,000 cash per year. But in real estate investing, same example. You put $20,000 down to buy the $200,000 house. And let's say you rent that house out for $2,000 a month. Well, by the time you pay your mortgage, your insurance, taxes, vacancy, and other maintenance costs of the home, let's say you pocket about $600 a month. That's going to add up to $7,200 a year. And $7,200 a year is 3.5% yield on that $200,000 property, but you didn't put $200,000 towards the property, you put $20,000 towards the property. So the $7,200 is 36% of the $20,000 that you put on that property. So you use leverage to get the yield of the whole property. And don't even get me started about the tax advantages that go along with all of this leverage that we're talking about. That's a whole nother video, and that's just as exciting. So click the little bell below and it'll notify you when I put that video out. All right, folks, that's equity and leverage. I hope you enjoyed this video. If you did, please like the button. It helps YouTube algorithm to suggest it to other people so that they can find the video as well. I'm interested in all things real estate, mindset, passive income, and long-term wealth. So if you have other ideas of videos that I should make, I love researching and making these videos. So comment below if you have any ideas for me. Give me your feedback, ask questions, flex your real estate deals below. I want to hear about them. I want to compare what some people are doing with what I've done. I'm working on a video next about my basement renovation project where I just finished my basement into an entirely separate unit that I'm going to rent on Airbnb. So I'm looking forward to sharing that with you as well. Thank you for watching and see you next time.